I'm curious when it comes to getting financing for a home for your, let's say your first home or another home versus getting or not refinancing, but for a home equity line of credit. Is one easier or harder than the other to attain?
Well, actually, in a lot of cases, a lot of situations, getting the HELOC can be more difficult.
Mm,
Um, and primarily the reason for that is the what I would call the core HELOC product in the industry. It's a variable rate loan, and it's variable because it's tied to prime. The prime rate, the Wall Street Journal prime rate, they call it. Now, that rate is a short term rate, and therefore it directly is correlated to the Fed funds rate. And so a variable rate HELOC tied to prime, it's called variable because the rate can change whenever the Fed funds rate changes. Well, from the underwriting perspective, after the lessons we learned in 2000, before 2008, the homeowner, the borrower, on a variable rate HELOC is not going to be qualified at the initial rate on the loan. That's because it's variable. The rate
mm.
could go up. So what lenders now do, what the industry now does to maintain focus on the ability to repay, which means being able to qualify based on debt ratio, but then also in a variable rate loan situation to take into account the potential for increases in the rate, not a decrease, you are typically going to be subjected to a formula that says, okay,